October 29th, 1929, a day that sent shockwaves around the world, marking the start of the Great Depression. Let's rewind a bit to the Roaring Twenties, a decade marked by post-war prosperity, cultural dynamism, and a booming stock market. A wave of optimism swept across the nation, leading many to believe that the upward trend of the stock market was indefinite. This was the era of buy now, pay later ethos, where people invested heavily in stocks, often on credit, hoping for a piece of the prosperity pie. The economy seemed invincible, the stock market a guaranteed path to wealth. But, as we know, what goes up must come down. By the summer of 1929, warning signs began to emerge. Production started to decline, unemployment rose, and debt began to pile up. Despite these red flags, the stock market continued its ascent, fueled by speculative investments. Investors were buying on the margin, meaning they were borrowing to purchase more stocks, a risky game that could lead to massive losses if the market took a downturn. And then, the inevitable happened. On October 24th, a day known as Black Thursday, the market plunged. Panic set in, and investors scrambled to sell their stocks. The following week, on Black Tuesday, October 29th, the market crashed. A record 16 million shares were traded that day, and the stock market lost 12% of its value. The aftermath was brutal. People who had borrowed heavily to invest in stocks were left with massive debts. Banks, having invested their deposits in the stock market, faced insolvency. The domino effect rippled through the economy, leading to bank failures, business closures, and widespread unemployment. The fallout from Black Tuesday was catastrophic, marking the start of a decade-long economic depression. This catastrophic event serves as a stark reminder of the dangers of speculation and unchecked optimism in the financial world. And yet, as we will see, the lessons of Black Tuesday would not always be heeded, leading to further booms and busts in the history of Wall Street. The Wall Street learned some harsh lessons from the Great Depression, and it was time to rebuild. The 30s and 40s were characterized by concerted efforts to stabilize an economy deeply scarred by the Depression. Measures such as the Glass-Steagall Act and the establishment of the Securities and Exchange Commission were put into place to prevent speculation and promote transparency. But it wasn't until the end of World War II that Wall Street truly began to regain its footing. The world was ready to rebuild, and Wall Street was there to finance it. The post-war boom was a time of remarkable growth and prosperity. The United States emerged from the war as the world's leading economic power, and Wall Street was at the heart of this transformation. The 50s and 60s were a golden age for Wall Street. The stock market was booming, and businesses were expanding at an unprecedented rate. A new generation of investors, emboldened by the post-war economic growth, flocked to Wall Street. The Dow Jones Industrial Average, a barometer of the health of Wall Street, skyrocketed. By the end of the 60s, it was 5 times higher than it had been at the end of the war. But this period of growth was not without its challenges. The Wall Street had to navigate the complexities of a rapidly changing global economy. It had to deal with new regulations and oversight, and it had to adapt to the increasing sophistication of financial markets. This period also saw the rise of new financial instruments, such as mutual funds and hedge funds, which brought new opportunities but also new risks. Wall Street had to learn to manage these risks effectively to avoid another crash. Despite these challenges, the post-war boom was a time of great innovation and opportunity for Wall Street. It was a time when Wall Street truly came into its own, becoming an integral part of the global financial system. The post-war boom was a period of immense growth for Wall Street, but it was not without its challenges. The 1990s brought about a new era for Wall Street, with the advent of the internet and the dot-com bubble. As we moved into this new decade, the world rapidly embraced the digital age, and the stock market was not an exception. The internet became a hotbed of innovation and entrepreneurship, birthing a host of new companies. These were the dot-coms, businesses operating primarily on the World Wide Web. The allure of being part of the next big thing led to an influx of investments, causing the value of these internet companies to skyrocket. This was the rise of the dot-com bubble. Investors, both individual and institutional, were drawn in by the promise of exponential returns. The markets buzzed with the names of these new companies: Amazon, Yahoo, eBay, each one promising to revolutionize the world as we knew it. The frenzy was infectious. Everyone wanted a piece of the pie. The Nasdaq, the index that housed many of these dot-com stocks, surged to all-time highs. But then came the turn of the millennium. The reality began to set in that many of these companies weren't generating profits, and in some cases, didn't even have a viable business model. This led to a crisis of confidence. Investors started pulling out, triggering a massive sell-off. The bubble had burst. By the time the dust had settled, the Nasdaq had crashed, losing over 75% of its value from its peak. Countless dot-coms went under, their stocks rendered virtually worthless. The fallout was devastating. Yet amid the wreckage, some companies survived. Amazon and eBay, for instance, managed to weather the storm and have since grown into global giants. They serve as a testament to the potential of the digital age, even as they remind us of the risks. The dot-com bubble was a stark reminder of the risks of speculative investing. It demonstrated the dangers of getting caught up in the excitement of a new industry without properly assessing the fundamentals of the businesses within it. The story of the dot-com bubble is one of caution and resilience, a chapter of Wall Street's history we should never forget. In 2008, Wall Street was hit by another major crisis, this time triggered by the subprime mortgage market. Let's take a step back to make sense of it all. Subprime mortgages, risky loans given to individuals with poor credit scores, were being packaged into complex financial products known as mortgage-backed securities. Wall Street, the heart of the American financial system, was heavily invested in these risky assets. Leading up to 2008, the housing market was booming. Home prices were soaring, and it seemed like everyone was buying property. Banks and financial institutions were handing out loans left and right, often to individuals who couldn't afford them. This was the subprime mortgage market. But then, the bubble burst. Home prices plummeted, leaving many homeowners with loans larger than the value of their homes. Mortgage-backed securities tied to these loans also tanked, causing billions of dollars in losses for Wall Street firms. Wall Street played a significant role in this crisis. Investment banks were creating and selling these risky mortgage-backed securities, while rating agencies were giving them top ratings. When the housing bubble burst, these securities became toxic assets, leading to massive losses and the collapse of several major financial institutions. The fallout was severe. The stock market crashed, unemployment soared, and the economy plunged into a deep recession. The crisis was not just confined to Wall Street or the United States, it had global repercussions. Countries worldwide felt the impact as their economies dipped into recession. The 2008 financial crisis was a wake-up call for Wall Street. It led to major changes in regulations and practices. New laws were enacted to prevent such a crisis from happening again, including stricter regulations on mortgage lending and higher capital requirements for banks. The crisis also led to a shift in the way Wall Street operates. Many firms became more cautious, focusing on risk management and long-term sustainability rather than short-term profits. The 2008 financial crisis was a wake-up call for Wall Street, leading to major changes in regulations and practices. And it serves as a stark reminder of the potential consequences when unchecked ambition and greed take the steering wheel in the world's most powerful financial hub. Wall Street's history is marked by periods of growth, followed by devastating crashes. From the crushing Black Tuesday to the dot-com bubble burst and the 2008 financial crisis, the story of Wall Street is punctuated by highs and lows. These episodes teach us the importance of prudence, resilience, and adaptability in the face of market volatility. They remind us that unchecked speculation can lead to disaster, and that sustainable growth often requires careful planning and risk management. They underscore the necessity of robust regulatory frameworks to protect investors and maintain market integrity. As we navigate the unpredictable currents of the financial world, these historical lessons serve as invaluable guideposts. As we look to the future, it's important to remember the lessons of the past. We hope you enjoyed this journey through Wall Street's turbulent history. If so, show us some love by hitting that like button. And don't forget to subscribe to BizBytes for more insightful content. Remember, in the world of business, knowledge is power. Subscribe to BizBytes and stay ahead of the game.